The final quarter of 2023 was quite an emphatic finish to what was an unusual year. We started the year expecting for a recession, for global growth to be negative for 2 quarters, and that didn't occur. And there's a number of reasons for that, most of which we've spoken about at length in the past. The rise of AI and the Magnificent Seven stocks, as well as some changes in interest rate expectations. But the fourth quarter was a pretty robust end to that year, and what we saw there was Australian shares rounded out the year with a strong quarter with an 8% return on the quarter. International shares delivered a solid 5%. And then when we look to the US, where you have something like the NASDAQ, which is their tech-heavy index, and what features most heavily those Magnificent Seven stocks, we saw that actually gain by a solid 7% in Australian dollar terms, or if we look at US dollar terms, it came out at 13%. Really a robust, really good end to the year for investors, really quite enjoyable. And when we think about what drove that, a lot of emphasis or a lot of attribution can be given to the impact of interest rate expectations. We like to conceptualize the potential risk as a barbecue conversation. So if you think about five families at a barbecue, all living through those cost of living pressures, all pressing to make ends meet, they're fine at the moment. But if you have just one family out of those 5 experience a redundancy, where the key breadwinner or one of the breadwinners has lost their job and can't quickly find another job, those other 4 families look at that and think, that could be us. We don't have a lot of buffer to fall back on if that happens to us. And so they start building that buffer. And to do that, they tighten their purse strings, they draw in spending, and they start saving. Now, we know historically, companies don't tend to lay off workers en masse whilst earnings are rising. So what we see is a bit of a vicious cycle or a vicious loop where lower constrained spending leads to more layoffs, and layoffs lead to more constrained spending. We see a mild recession, i.e. two quarters of negative growth, not strongly negative, and maybe not even much longer than 2 quarters, but we do see a light recession as probably our core investment case. However, as we saw in 2023, things can play out much differently to what you expect. And we're open to the idea that, as the economy has been surprisingly robust, it may continue to be surprisingly robust, and we might actually achieve one of those rare soft landings that everyone's talking about. We do see the environment as being more primed for conflict and for those things to go on. The good news is most conflicts don't really impact markets, certainly not in the medium and long term. In the short term, you might see a short spike as people are pricing in risk of escalation or unknown unknowns, but very quickly they adapt to that. So when we look over the major sort of conflicts that have arisen over the past few years, with Russia invading Ukraine, and indeed with the flare up in the Middle East, you can see those events on price charts for investment assets, and the impact is very fleeting. One thing that we should draw out, of course, is the US presidential election, and we're certainly going to see a lot of that on our news feeds. It's going to be a very contentious election. I think we are suffering from a lack of support for either Donald Trump or for Joe Biden, and as a result, that's likely to lead to a very negative campaign for both parties. So that's going to be front and center, but we don't actually see any reason to worry at this point in time that it might have any pronounced knock-on effects for our investment outcomes.